Hello, I'm Joyce Barrett, and I'd like to welcome everyone to today's webinar. Webinars are brought to you by the generosity of Heritage Ohio supporters. We invite you to become a supporter too at heritageohio.org. Heritage Ohio's mission is to help people save the places that matter, build community, live better. Today, we will have a presentation on Historic Tax Credits 201. Last week, we presented Historic Tax Credits 101, and you can find a recording of that webinar on the Heritage Ohio YouTube channel. I've also included the link down in the chat box if anyone wants to copy that out. We will be taking questions at the end of the presentation. If you have a question, please type it into the question box at any time, and then at the end of the presentation, we'll be reading those off. If you have any issues with the webinar software, they can usually be solved by signing out and re-signing in. You can also see on your webinar panel to the right, handouts. Each one of the presentations has been loaded, and you can download those presentations from the handout box. The recording of the presentation will be sent to all participants in about 3 hours. Our presenters today are Chad Arfons, who's an attorney with McDonald Hopkins, Alyssa McClanahan with Kunst, and Paul Nadin with RMS. And we're going to start the presentation by handing the controls over to Chad. Take it away, Chad.
Thank you, Joyce, and good afternoon, everyone. Can you see my screen?
Yes, your screen's live.
It looks good, Chad.
Okay, great. All right, thank you. All right, so I'm going to jump into this, and I guess first off, I'm going to assume that you've watched the 101 presentation that Joyce mentioned. It provided a great foundation for the tax credit programs and how they work, and a terrific introduction by Barb Powers, Mary Angela Feaster, and Lisa Brunell. So I'm going to assume that we're kind of starting from that standpoint and move forward from there. Let me see. Sorry, my controls are not working, Joyce. Nope, there we go. Okay, so I guess the way I view the historic tax credit program is it's essentially kind of two tracks. There's, on the one hand, you've got kind of a tax and accounting track where the IRS is involved. There's the process of actually claiming the tax credits, passing them through to the partners, and essentially receiving the tax benefit from the credit. And on the other hand, you've got kind of what I consider kind of an architectural track that involves the Part 1 approval, the Part 2 approval, and the Part 3 approval, which are essential in order to claim the credit. But in a way, those are kind of two parallel tracks that run, and you've got, on the tax side, you've got an accountant like Paul involved, assisting you through that process. And on the architectural side, you've got a historic consultant or architect like Alyssa involved. And so that's, to me, fundamentally how the credits are laid out. And for purposes of this presentation, I've created kind of a third track just to give myself a role here, which I'm saying is essentially partnership agreements and project financing. And that's essentially where the tax credit investors get involved and the lenders and the money to develop the project comes in. So that's kind of the basic framework for how I look at the credits. So I'll allow Paul to kind of go into greater detail in terms of the tax side of it and the accounting issues, which are numerous and very tricky. But I think one of the key things at a high level on the accounting side of this or the tax side of it is that you're going to want accountants to prepare financial projections for the project. And those financial projections are essentially kind of a model that sets forth the estimated project costs, the sources of funding to pay for those costs, a pro forma for the operating costs and income over the life of the project, and also an analysis of the tax benefits that are derived from the project. Those projections can be very simple if your project does not have a kind of an institutional tax credit investor. It can be basically much like any real estate project in that sense, or they can be very complex if you do have a sophisticated investor involved, or if you have a complex capital stack of multiple funding sources, then those projections can be very complicated. But it really lays out kind of a roadmap for how the project is anticipated to go from a tax and financial standpoint. So it's very important piece of the overall puzzle. And again, Paul will go into that in greater detail. And then from the architectural and historic approval standpoint, Alyssa will go into this detail. And really, again, the 101 program provided a good overview of this. But, this is where we've got the Part 1 approval, the Part 2, the Part 3, the plans and specifications for the project. And, really, this is the roadmap for how the project gets built and how it is done so in a way that complies with the historic standards that make the credit possible. So then that leads me to essentially the partnership agreements, which I'm using the word partnership, but typically it's a limited liability company that's involved in these transactions that is taxed as a partnership. And the point of it is really that it's multiple parties coming together in an entity that is taxed as a partnership, meaning that the tax benefits flow through out to the individuals and entities involved. So I use the term partnership, or I may say operating agreement, but I basically am using that kind of interchangeably. But one of the trickiest things about using the historic tax credit, the federal historic credit in particular, is that the credits are not bought and sold. You'll often hear the term, we're selling the credits to an investor or something like that. And technically, they can't be bought and sold. They have to be allocated to partners who are owners of the company that are involved in the project. And so that's really where the operating agreement or partnership agreement becomes an important document to this overall transaction. So with that bit of complication introduced, it leads to really kind of a fundamental question on these deals, and Paul will go into this in greater detail as well. But it's a question of will the sponsor, which I mean the developer or the property owner, the parties that are really kind of pushing the project forward, will they use the credits themselves, or will they bring in an outside investor to use those credits? And I go through it real quickly here, but essentially suffice it to say that not all taxpayers can use the federal historic credit. And again, Paul will explain that more, but that's, I guess we'll leave it at that for now, that not everyone can use it. And it doesn't matter if you're high net worth or if you make a lot of money, it's a more nuanced question than that. And the next point is that the federal credits are allocated to the partners based upon the percentage interest that they own in the company. And I'll go into that a little bit more. Kind of 2 points that make the Ohio credit much easier to use. One being the Ohio historic tax credit is refundable, meaning that if you are a taxpayer, you can file a tax return. And if you don't have tax liability, you can get a refund. So that makes it much easier to monetize than the federal credit. And then the second point is that the Ohio credit can be specially allocated to the partners. So for instance, a partner who owns 1% of the company could be allocated 100% of the state credit. So it really adds a nice flexibility to using the credit. So here's a structure diagram that we often use on these deals. And it kind of helps me explain it and hopefully helps you understand kind of how the relationships of the parties. This structure is not universal. It isn't always this way, but this is a fairly common way to structure a deal. And I would say that for purposes of this discussion, we're going to assume that there is an outside investor that is going to use the credit. And that doesn't have to be a big bank or an insurance company. Typically on big historic tax credit deals, it's going to be, the investor is going to be a large publicly traded company. On smaller deals, it could be individuals, it could be a group of individuals, or again, as long as they meet the requirements for being able to use the credit. So essentially this structure can be used irrespective of how large or small your transaction is. Just to quickly walk through it, in the middle of the diagram, you've got essentially the company that owns the building, owns the historic building, and it has as its members an investor member that's off to the right that owns 99% of the company. As a result of owning 99% of the company, it gets 99% of the federal historic credits. In this case, we've allocated 100% of the state historic credits to that same investor. And as you can see there in the description of the ownership, that investor owns 99% of the company until the end of the recapture period, which is 5 years from completion of the project. And then the interest flips to 5%. Then on the other side, we've got essentially what I'm calling the sponsor, and that party owns 1% of the company until the recapture period, and then it flips to 95%. And that party is essentially the person who is in control of the day-to-day affairs of the company. They're making the day-to-day decisions about the company. So just getting into the partnership agreement, again, operating agreement, a little bit more here. As I described, the building is typically owned by a pass-through entity, and the parties enter into a partnership agreement. The purpose of the partnership agreement at its most basic is really to lay out the deal between the partners. It admits the partners into the company. It establishes the timing, and this is a critical point, establishes the timing and the requirements and amounts for each party's capital contributions, and then the other kind of duties and obligations, which typically the investor is kind of a silent partner, and the duties are that the managing member, essentially complete construction, oversee the day-to-day affairs of the project, make sure that it leases up and is as successful as it can be, and does nothing to cause a recapture event. And the investor member essentially expects that it will receive the benefits of the tax credits and the other tax benefits of the project. It will make its capital contributions, and at the end of the compliance period, as I described, it's typical that there might be a flip where the percentages shift away from the investor member and go to the managing member. This doesn't have to be the case, but it's often the case. And the other component that it can often include is a put option, where the investor has the right to sell or require the managing member, I guess more accurately, require the managing member to buy it out at a price that is at or below fair market value. And those would occur, the flip and the put would occur after the recapture period. From the standpoint of the investors' capital contributions, typically what we see is that the investor will put in 20% of its total expected capital contributions at the time of the closing of the transaction, at the time that they're admitted as a partner, and then they would make their additional capital contributions essentially at completion of the project or stabilization, when it's been determined that the project did comply with the historic requirements. You've gotten your Part 3 approval, and you've gotten your cost certification setting forth the amount of the QREs, so they know how much tax credit they're going to get. I'm not going to go into great detail in terms of the safe harbor slide here, but essentially what's important is, again, that the credits have to be allocated to partners, which is more than just two people involved in a company together. It also means that there's a shared risk and reward. And essentially the IRS set forth a safe harbor to try to essentially help people putting together these tax credit deals to make sure that they structure their deals in a way that made it so that they were partners. This concept of kind of buying and selling credits kind of went too far, I suppose, and the IRS came in and established this safe harbor to kind of set forth guidelines for, if you follow these guidelines, you structure your deal accordingly, then they'll respect it as a partnership, and it won't appear to be an attempt to buy and sell credits. So now moving on, in terms of project financing, it's really, at the end of the day, it's a real estate deal. And so you've got a construction loan, you've got a permanent loan, fairly typical first mortgage. Oftentimes they can be certainly more complicated and many layers of financing, but at the core, it's a real estate deal. I would say some of the nuances are that an institutional tax credit investor is likely to require that the lender enter into a forbearance agreement where the lender agrees that they won't take any action such as foreclose for 5 years, which avoids some recapture risk. Additionally, the investor is going to want to see that the permanent loan essentially takes it out past the end of the recapture period, again, to avoid an event that a loan matures early and there's a problem that may cause a recapture. Another nuance to these deals is that because the investor is putting in typically only 20% of their money at the beginning, there's a lack of funds to complete the project. And so we see deals have a bridge loan where a lender essentially advances loan funds to the project, and those funds are repaid at the end of the project when the tax credit investor has made its capital contribution, it's received the benefit of the credits, and then the company can receive those funds and pay the bridge loan. And typically those bridge loans are secured by a pledge of those future capital contribution inflows. So I think I feel like I kind of raced through it here, but I'm at my 20-minute mark, and so that takes me to the end, Joyce.
Okay, thank you. And Chad will be here to answer your questions. We're going to change presenters to Alyssa.
Good afternoon, everyone.
There you go.
Everyone seeing my screen? Okay, awesome. All right, good afternoon. I'm a historic consultant based in Cincinnati, Ohio. So I'm going to talk through what I do as a historic consultant for these historic tax credit projects, if you choose to hire one for your project. So the first thing that a historic consultant assesses about a project is whether or not the building qualifies for the 20% federal and the 25% state credit, the percentages referring to your qualified rehabilitation expenditures. So for the credits, in addition to meeting the substantial rehabilitation test, I check to make sure that the building is income producing and a certified historic structure, meaning that it's either listed in the National Register of Historic Places or it's a contributing structure or landmark in a National Historic District or another certified historic district. There are lots of local certified historic districts. To be considered contributing, the building must be built in the time period of significance attached to the district that it's in, and it has to have some historic integrity in terms of its fabric remaining enough that it is considered contributing to the character of the district. To figure out your district, you can email someone at the State Historic Preservation Office, SHPO. You could talk to someone like me. A lot of times there are really neat GIS tools online. We use CAGIS, for instance, for Hamilton County. Easy to figure out where your building is located. For the Ohio competitive state credits, in addition to the federal requirements, it cannot be a single family residence and it cannot be a multifamily residential condominium. There's always the possibility of federal designation if your structure isn't in a district or isn't on the register. And a historic consultant would know how to do that and walk you through that. But the really important caveat is that federal designation can take many months, sometimes a couple of years, depending on the project. So if the project really is worth it and you want to do a designation, you need to plan way ahead. So as a consultant for my clients, I manage the federal Part 1, 2, and 3, and the competitive state online application for Ohio. Other consultants that I know of only handle the federal part, writing up your Part 1 and Part 2. So just be clear when you're hiring someone or thinking about it, thinking about what you want them to do, how much of the whole tax credit consulting process you want them to take on. But like I said, for most of the projects I'm involved in, my clients are interested in pursuing both the state and the federal credits, which means we're tied to the competitive state rounds and those deadlines. If you're not doing state credits, you can apply whenever for federal credits. But for the state, as Lisa Burnell made clear in the first Historic Tax Credits 101, those are every fall and spring. And in non-COVID-19 times, they're every February and March and August and September, wherein you have to get your Part 1 and Part 2 in by the end of February to apply for state credits at the end of March, and the same pattern holds for August and September. So your consultant should be really aware of those deadlines and helping the developer and the architect, if there is one, work ahead to meet those deadlines. Those deadlines are not movable at all. There are also many deadlines where you also have to absolutely meet these or you are disqualified for the state credits. You have to request a pre-application meeting with SHPO. You have to hold that pre-application meeting. You have to submit an intent to apply for the state credits. All of these things are easily found on the SHPO website and the Ohio Development Services Agency website, but you absolutely have to click those links and fill out those forms in order to meet those deadlines. The other important things to keep in mind is that, again, in non-COVID-19 years, everything with SHPO and then the National Park Service is mailed. It's all paper. So you and your consultant really need to plan ahead in terms of getting all that stuff to Columbus and then eventually to Washington, D.C. So for the federal process, I do the Part 1 and the Part 2. The Part 1 involves historic research on the building. I do this through historic city directories, old Sanborn insurance maps, historic newspapers. All those can be found for you or your consultant through your local library. I also do research through genealogy databases, to better understand who lived at a building or how it worked. So the part one is both a narrative description of that history as best as you can find out, and then a physical description of what the building is like now for the owner. In combination with this narrative, you have to provide a map showing the building in a historic district. SHPO can help you identify that map. They're often found very easily through Googling the district and Googling National Register nomination form. The other component to part one that I do are extensive photos. So SHPO needs to be able to get a sense of what the building looks like on the inside and outside. And so your consultant will generally take 2 to 4 photos per room, sometimes more, resulting in anywhere from 50 to 100, sometimes more photos per project. And they'll print those out, they'll label them, they'll key them to a floor plan to help SHPO and NPS people understand what the building looks like. SHPO now requires some exploratory demo photos, which better allows them to understand what is underneath certain parts of the building to get access to underneath deteriorated stuff. Is there any good historic fabric under there? So that's something your consultants would be aware of and able to do. The part two then is also a narrative, and it goes through each part of your building, the windows, the floors, the ceilings, the roof, etc. And it explains, what does it look like now? What do I want to do with it? And so for someone like me, this is coordinating what the developer and the general contractor want to do with the building, aesthetically, financially, and then what they can do because they're pursuing historic tax credits. And so I think a good consultant, their job would be to walk a fine line between understanding the Secretary of Interior standards and appreciating them, promoting them, and also understanding that a developer needs to do certain things with the building within reason to get certain residential and commercial rents for their pro forma. So a consultant should be, I think, amenable to both those perspectives and an advocate for both SHPO and NPS, but also the developer. My big job as we're walking through a project in its initial stages and I'm writing up to part two is to make a developer and a general contractor aware of both the Secretary of Interior standards for that particular kind of building and also what SHPO calls BSRs, Basic Submission Requirements, which are required now for all Part 2 submissions. And so SHPO and NPS have developed these basic submission requirements, certain plans, certain details that consultants are aware of, and so they can explain that to the developer saying that by the end of February, for instance, I need to have a floor plan that's showing X, Y, and Z. A consultant will also walk the developer through and make them aware of what are known as red flags, and these are just things that blatantly don't 100% do not meet Secretary of Interior standards. So these things could include just demolishing way too much historic fabric, drastically changing a historic layout or the flow of a building, adding on a very large uncompatible addition, stuff like that. So per historic district, buildings are supposed to be renovated in a way that make them still compatible with the period of significance. So that's how architectural and design decisions are weighed at SHPO and NPS. So the consultant's job then is to know the kind of building you're working with, the period it's from, the architectural style, how it was historically used, and then navigate the developer and general contractor through that renovation plan, making them aware certain things are just off the table, and then other things they want to do that maybe are a little controversial, negotiating and working with SHPO and NPS to see, is it possible to do this, or is that really not going to work as well? The ultimate goal at the end of the part two is obviously to get something that SHPO and NPS approve, but it also needs to be a very clear roadmap for the developer, but especially the general contractor who's on the ground in the building every day. I recommend creating a project log that essentially summarizes your part two, which can be really long and wordy. Create a project log for the men and women actually in the building working on it that's really clear about what they are supposed to do in terms of historic preservation treatment. The other thing I want to mention in terms of writing the Part 2 is that I often work with an architect or an engineer hired by the developer per project. SHPO and NPS now require a lot more documentation up front than they have in the past. A lot of floor plans showing existing and proposed drawings, elevations, specifications of new windows, for instance. The larger projects that are doing mechanical work, SHPO requires at Part 2 submissions that you provide those MEP plans showing plumbing and electric runs, sprinkler locations. So for larger projects, I think it's really important to have that architect and or a mechanical engineer part of the team. That said, if your project is small enough, you definitely do not have to have an architect or engineer, especially if you're not doing mechanical work or messing with roof lines or anything like that. It's also important to remember that SHPO and NPS don't require you to have an architect and to have architectural drawings that are really professional. They're very amenable to work with you if your project is small and you don't need to show them mechanical plans. They always let you do hand drawings, stuff like that, to just try to make the program really accessible. So that's important to keep in mind. So as I mentioned before, I do the competitive online state application for my clients as well. So I'll talk briefly about that. As Joyce and Chad mentioned, Lisa Burnell is a great resource at Ohio Development Services Agency, ODSA. They're the people that run this part of the program, so not so much SHPO or NPS. This is, again, has the 2 rounds every March and September of every year, the spring and fall rounds. To participate in that round, you have to have submitted your Part 1 and Part 2 prior to that. So if you're trying to submit a state application by the end of March 2020, you have to have submitted your Part 1 and Part 2 by the end of February of that year. And those deadlines, again, are not flexible at all. So for your state application, you're proving your project's economic and community development, and it's a scored application out of 100. And what's neat about this is that for all the categories on the application, except for one, it's all self-scoring. So you should know, your consultant should know ahead of time what you will get. And so for my clients, prior to them embarking on a project, I run what I call a fitness test, which just projects possible scores so that the developer has an idea of how competitive their project is and what kind of financing they'll need to bring to the table. So I think for this part of the application, the state application, consultants should be really familiar with the application, the guide, which you can see on your screen, be really familiar with the different categories and the points that you can get. And you can find all of this, the application guide and information on the ODSA website. As a consultant, I have kept data on all the past rounds for the state application, the Ohio state application, so that when I'm doing an application for a client and I'm projecting a certain score for their state application, like a 60 out of 100, for instance, I can tell them that based on the past several rounds that their project is either looking competitive or not, meaning likely to win or not. So for that ability to project that, I think knowing past data is extremely important. It's all public information. You can email Lisa and she will give you all sorts of data from past rounds. I think either you or your consultant should really spend time digging through that data. It's got great information in terms of figuring out how competitive your project now or future projects will be. It's obviously important to point out, and I'm sure Lisa covered this, that there are different pools for the state application. I believe most people on this call, I was told, are probably in the small pool, meaning that your QREs, your qualified rehab expenditures, should be under 1.25 million. So you're in the small pool competing only against other people with similar sized projects. There's an intermediate pool and then a pool for large catalytic projects. While the small pool is competitive in and of itself, generally I have seen the larger your project, the much more competitive it gets in terms of winning an intermediate and catalytic project for the state application. So for the state application, the consultant or if you're doing it, has to provide a ton of documentation, project budget, pro forma, proof of financing, leases for any commercial spaces. So it's like with everything with the tax credit process, just really good to work ahead of time because sometimes it takes a while to get those documents together to meet their deadlines. You absolutely have to own the building or have a qualified lease on it to apply for state credits, which is not the case for federal. You can apply on behalf of an owner for the federal. That's not true for state credits. You have to show proof of ownership or a qualified lease. An important part, in addition to getting all of the other documentation together for the developer, another important thing that the consultant should help you with is getting city letters of support, which earn you several important points on the application. A letter of support for your project from your city mayor or county executive, and then documentation from your city or county of a financial commitment. For a lot of my clients in Cincinnati, this is generally proof that their project is eligible for a commercial tax abatement, for instance. And so I work with city officials to get a mock commercial tax abatement drawn up. So your consultant should be familiar with that and also have those connections with city or county folks to make that requirement easy. Thinking about finishing the project, historic consultants will generally check in through the project, filing any amendments that you need. Amendments are revisions to your original Part 2. They're not difficult to file, but they take 60 or more days to get approved. So consultants and their developers should be aware that filing tons of amendments will really drastically slow the construction process. When the project is finished and ready to be placed in service, your consultant would file the Part 3. So that's a federal form that you would find on the National Park Service website. And then you're also going to fill out some state forms. That'll be through Lisa Burnell at ODSA. In addition, your consultant will take photos of your project at its end, showing kind of the after effect of all the renovations. So it'll be similar perspectives to the original Part 1 photos. And I would just put on the PowerPoint that to check in with Lisa frequently as you're finishing, because in the past couple of years, the timeline through which you want to claim your state credits has changed. And so that's something that you want to be on top of and aware of ODSA's latest way for claiming the state credits in terms of the timeline of I have my C of O, I have the building done, when can I submit all this information and what year can I then claim the credits in. In terms of finding a consultant, a couple of useful recommendations would be to consult the SHPO list. The link is on the slide. You could also ask your local preservation organization, historic preservation organization. These people do historic preservation for a living and are really great advocates, and they, I'm sure, will know of people. You can also ask around. A lot of consultants are always looking to pick up additional projects, and sometimes if you know of a development project that you liked and it's kind of a similar size maybe as what you're thinking about doing, sometimes the developer or owner will share their consultants with you. Lastly, just a couple of quick things to keep in mind. The realization that local historic guidelines will sometimes exist for your county or city. Those are not necessarily the same things as the federal historic guidelines that I've been talking about today. I think a historic consultant can be really useful in navigating the difference between the two and working with your city or county to figure out how you can get local approvals as well as the federal approvals for the historic tax credit process. And then lastly, I think it's helpful for your consultant to know some really kind of basics for building code, particularly around egress and fire safety. Obviously, architects know that stuff inside and out. I think it's also helpful for your historic consultant to know that stuff. Change of use often triggers certain requirements for fire safety and egress that can be really expensive and nightmarish for developers. So hiring somebody that knows that stuff, even just generally, is really, really helpful. And I will now pass it to Paul.
Okay, hold on here a minute while I pass it over to Paul. Okay, Paul, you're ready to go.
All right, thanks, Joyce. Thanks, Alyssa. Good afternoon, everyone. I think Joyce did this purposely, but you put the accountant at the back end of the presentation. So, if I'm boring you and there's too technical, you're going to be dropping off. So I'm going to try not to look at the list of participants and seeing the number drop off here. So let's get started here. So what I want to go through here, I know we went through some of the basics on historic tax credits at the 101. I'm going to do a little bit deeper dive in how to qualify, what qualifies for the initial part of the presentation here. Then secondarily, I'm going to get into talk about the impact of the tax reform that took place at the end of 2017 and the impact on credits and placing in service, et cetera. Next piece I would be talking about then is to talk about, and Chad talked a little bit about this, is looking at whether you're going to self-monetize this. If it's a smaller project, there's some certain transaction costs just to structure a transaction that self-monetization may make more sense versus going to a third-party, larger corporate investor. And we'll get into some of the details there. Then the next one down the list, we're going to talk about tax-exempt entities and tax-exempt issues with ownership and leases associated with nonprofits and that. And then finally, just touch quickly upon other incentives that may be available for historic projects. So getting into the basics here, as you're probably aware of, at the federal level, it's a 20% credit based on qualified rehab expenditures incurred on a historic project. General requirements include a substantial rehabbing the building, which we'll get into more detail and discuss how to meet that test. The building had to have been previously placed into service. It needs to be a certified historic structure, meaning that it's individually listed or part of a historic district, and that for IRS purposes, the building and the rehab costs need to be depreciable. So let's talk about the substantial rehab test. Essentially, it's basically saying that you need to incur more qualified rehab expenditures than at least 5,000, or the bigger test is to exceed your adjusted basis of the historic building. So a lot of times it's really looking at what you paid for the building, and then you're going to take your QREs and compare it to what you paid for it. So for an example, if you paid 500 grand for a building, if you incur $501,000 or $501,001, then you would qualify and you'd be able to take credits with those based on those QREs. There's two different measurement periods out there. There's what's called either a non-phased or phased project. And so if you have a non-phased project, the window in which you need to incur these QREs to exceed your basis is a 24-month period. The IRS allows you to extend it out through the end of a fiscal year, but generally speaking, it's a 24-month period and a 24-month window. Then there's also a phased project whether it's multiple phases, maybe, or just, a lot of times you'll see it in a mixed-use building where you have residential units on the upper floors, and the first floor might be some retail or a commercial build out in which you may have multiple phases, and that gives you a more of a window to basically incur those QREs to meet the test. To be as I mentioned earlier, to be a historic structure, you got to be either individually listed or being part of a district. And then also, generally speaking, to be on the nationally registered, you must demonstrate some historical significance, and typically the building needs to be 50 years. It's not always the case, but it's pretty rare that a building less than 50 years would qualify. Eligible expenditures to qualify for tax credits. It's basically anything that we can capitalize as part of building. So anything hard construction costs, your soft costs associated with it, architectural engineering, sometimes quite a bit of legal, and then you've got your construction period carry costs as well, your interest costs, your utilities, real estate taxes would qualify. Really, the way to think about it is the other way is the kind of everything qualifies other than acquisition doesn't qualify, FF&E, I always say anything that's loose in the building. So if you picked it up and shook it and things fell out, those things would not qualify. Your tables, your chairs, a lot of time appliances, and that would not qualify. Additions also do not qualify. So anytime you increase the envelope of increase the size of the initial envelope, that would not qualify as a QRE. And then lastly here, site improvements, landscaping, parking lots, paving, sidewalks, those would all not qualify because again, they're outside the envelope of the historic structure. There is a tax credit recapture, a possibility for tax credit recapture with the federal program here, where there's a 5-year compliance period, and that starts from the time you place the qualified rehab expenditures into service. And essentially then there's a burn off of that recapture period, basically 20% per year. So if the handful of different recapture events here are listed here is if you sell the building, building ceases to become income producing property, a partner or owner that would dispose greater than 1/3 of their interest. For some reason, if the NPS would remove the building from the National Register. And then lastly, if the building is destroyed by casualty. Just to touch about historics, I know Chad talked, or the state historic program here for Ohio. I know Chad briefly talked about it, as well as Alyssa went into some pretty good detail on the application process. This is rather than a 20% credit at the federal level, this is a 25% credit. So you get a bit of a boost there. As Alyssa went through in pretty good detail, it's a competitive application process with different pools, and again, the larger the project, the more competitive that pool becomes. The credit is limited to a $5 million max, so that's $20 million in QREs, where you kind of cap out on the credit. And the one thing that's different here as well is there's no recapture or compliance period. So a lot of times, when you're monetizing with a third party, you don't have to have them in a partnership, for the full 5-year compliance period. You might take them out after a year or two after the building's placed into service. The other 2 points I want to come back to as well that I don't have noted here, but Chad had noted is, and this is crucial if you're trying to structure the transaction, especially if it's a smaller size, is that this credit is refundable up to $3 million. So an individual could take it on their personal return. It's refundable from the state. It becomes, but keep in mind, it becomes taxable at the federal level as well. So just something to keep in mind, that sometimes it's easier to actually go out and monetize because you'll get more bang for your buck, kind of after tax than that. And then lastly, too, what Chad had mentioned in his presentation is that it could be specially allocated. So it gives you a lot more flexibility in structuring transactions, because you can admit somebody that's a much smaller partner, but still allocate 100% of the credit to them if they have the appropriate tax liability. All right, so let's talk about tax reform implication. Again, the Act's now a couple of years old, but what I want to talk about is really kind of changes before and after, and how it affects recapture, but also your substantial rehab test as well. So underneath the old law, when you placed in service your qualified rehab expenditures, you would take the full 100% of the historic tax credit in the year that you placed in the service, so the full 20% credit. Now the new law tells you that you've got to take it in ratably over a 5-year compliance period. So there's, so in essence, certainly this comes up as an issue when you're trying to monetize it with a third-party investor, where we've seen pricing, a depression on pricing, because there's a time value of money here, where an investor is going to put X amount of dollars in for the project through completion, and now they're going to have to wait 5 years to get the full benefit. So there's been some depression on pricing as a result of the new rules. Also, the underneath the old rules, there used to be, in addition to the 20% credit, there was a 10% commercial rehab credit, and it was in the industry called the old building tax credit. It was basically a commercial property, non-residential, that was initially that is not listed on the historic registry as a historic project. So that's been eliminated with the new rules. And then the transition rules to, then there's the transition rules to basically say if you're in the old law or the new law, and in order to meet the old, transition rules to still follow the old law, the property needs to be owned or leased on or after January 1st of 18. So if you don't own it now, you won't pass the test for the transition rules. And then secondarily, not only do you have to own it as of the 1st of 18, you also have to meet the substantial rehab test no later than 100 days after the act. So, or the rehab measurement period must start no later than 100 days after the act, meaning that we'll get into some details that let's look at the chart here really quick. So again, this is you'll note up at the top, it's a non-phase, so 24-month window. So earlier I just mentioned about the sub-rehab test, that if you have a non-phase project, you've got essentially 24 months to incur your QREs. And this diagram is hopefully lays out, kind of the timing of, not only do you have to own the building at the very beginning of January of 18 there towards the left, you have to then be deemed to start your substantial rehab test period June of 2018. That's 180 days from the enactment of the tax reform. And then the next date is that 24-month window. You must meet the substantial rehab test as of June of 2020. So we're really just a couple months away from that, and so that's your 24-month window, basically saying that, again, you have to incur more QREs than your acquisition basis. And then finally, because of the IRS, they allow you to then continue to take QREs and incur QREs through the end of the fiscal year, so that as long as you place the building into service by the end of December, then you could still qualify for transition rules, meaning, again, that you can take 100% of the credit in the year that you place it into service. The second diagram here, this is really for the phase project. All it's really showing is that it gets extended out a few more years, because it's 60 months versus 24 months. So basically just gets pushed out 3 years. And so if you do have a phase project and you owned it as of the 1st of 18, you still have some runway to get the project done and meet the transition rules. I'm not going to go into too much detail here and really let due to the amount of time that we have and the time restrictions. But these next two diagrams kind of show that there's what the difference would be if you had a recapture event underneath the old rules versus the new rules, and it really just has to do with when credits are available on that. But I won't go into too much detail there. Next section here is talking about really, kind of the purpose of these credits in the first place, right? That historic rehabs are inherently more costly than typically ground up construction. So the incentive is there to try to monetize, either self-monetize as a developer ownership group, or go out to a third-party marketplace and actually go monetize credits. And again, this is state and federal credits. There's markets, again, third-party, but to kind of get into this, self-monetization, a lot of times we have developer clients that say, yeah, we've got some income and think we can use these credits, but there's really it becomes problematic for a couple of reasons. Number one, if you may not have the appetite as an ownership group, because a lot of developers and real estate professionals have depreciation losses flowing through from other entities. And so, to be able to self-monetize it, number one, if you can't use it in the year that it's available to you, you can carry it back 1 year and carry it forward 20 years. So you may not necessarily lose it, but you may not be able to use it immediately. Secondarily, and more importantly, is these credits are only available to be offset against passive activity income. And so there's really kind of three different buckets of income. Passive activity, which is really basically saying you're not active in it. Real estate is automatically passive activities. But then other passive activity income would be from having ownership in businesses where you're not actively involved in management. And the other two buckets would be portfolio income, your interest, dividend, royalty income, and then lastly, active income. That's W-2 wage income. That's actively owning and managing a business. And then there's one exemption to get around the passive activity rules, and that's being a real estate professional. And there's a two-pronged test there where either you spend more than half your time participating in real estate activities, and you have to then also prove out that if that is your only activity, that you're spending at least 750 hours a year in real estate activities. So that's self-monetization and some of the issues associated with it. Just to really quickly touch upon syndication with third parties. Again, Chad went into about structures, and there's multiple different structures where you may admit a partner. Pricing, I just want to point this out really quickly, that depending on if you're a transition deal or a non-transition deal, and I mentioned that time value of money concept because of taking the credit over 5 years, your pricing could be anywhere from 60 to 90 cents. Also keep in mind the size makes a difference too. So you may, in order to even be able to talk to a third party investor, you're really starting at $1 million of credits plus. So you got to have at least 5 million of QREs to even start, going out to that third party marketplace. Again, just due to economies of scale on that. And then also just, again, in talking with Joyce and potentially the group that's on this call, one thing is if you can't self-monetize and it's too small of a project, maybe you consider and look to local partner groups that may have interest, and so that might be a play as well. And we've certainly done that in the past as well, where if there's certain stakeholders within a community that they may come to the forefront and may be able to benefit, especially if you spread it out amongst multiple partners. Tax-exempt issues. Touch upon this just because this a lot of times comes up on deals, especially if it's kind of more mainstream and type of projects where when you start having there's some limitations when you start bringing in tax-exempt nonprofit organizations. Number one, cannot lease, and basically saying that it's one thing that's mentioned in the industry is that there's a tax-exempt taint. Basically, essentially, if there's disqualified leases or if there's ownership from a nonprofit. So one thing to note here is that you want to make sure that you don't have more than 50% of the property being leased to a nonprofit via a disqualified lease. There are multiple ways to get around it by structuring leases in a way here that's noted that if it's less than 20 years, renewals are based on fair market rents and there's no fixed option to buy out the property. There's ways to get around it. But generally speaking, is you want to steer away from having too many nonprofits in a project, but there's a lot of times ways to structure around it. The nonprofit, if they currently own the property, cannot own it directly. They would have to flip it into a for-profit structure, and then they also cannot participate in financing. And the last thing again, just to touch upon here with nonprofits is, even if you can make it work, a lot of times you want to make sure that if a nonprofit owns it and is going to flip it into a for-profit structure, you want to make sure that you look at what happens if you can't get an exemption on your real estate taxes, because a lot of times I've seen that where it may kill the benefit of the tax credit if you end up getting assessed a large value on the real estate taxes. And keep in mind, it's a 5-year compliance period. So for at least 5 years, you may be paying a higher real estate tax, which is going to kill the benefit. And lastly, running here just a couple more minutes here. Just want to mention here that we talked about state historics and federal historics, that as combined credit, it's 45% of your eligible basis. And when monetized, you're looking at 30 to 35 cents on the dollar you're getting back in tax credit benefits or tax credit equity when it's monetized. But there's also other benefits out here to ownership if it's opportunity zones, and potentially to raise some equity, new market tax credits, low-income housing tax credits. There's various different state level incentives as well. And then, a big one also ultimately is a lot of times real estate tax abatement and tax increment financing is also another good way to bring additional sources to the capital stack. And with that, I'll kick it back to Joyce.
Okay, thank you very much, Paul. Okay, we have a few questions that have come in, and please feel free to type in your question and also give me some clues if there's another aspect of this whole thing that you would like a presentation on. The first question, why does the investor remain in the deal after the recapture period? I think you had mentioned this, Chad.
So typically an investor would not stay in a deal after, but we have deals, as Paul said, where there's perhaps a local partner who can use the tax credits and who is basically part of the team that wants to be part of the long-term ownership. So that's really more a scenario of like self-monetization, where maybe one of the partners who's doing the project can use the credits and wants to stay in the deal long-term. But as an institutional investor, they would typically get out after 5 years, and I've never seen an investor stay in past the 5 years.
Yeah, and this is Paul, and that's what I've seen as well. And generally speaking, that's what they're there for. I mean, they're not going to hang around after the 5-year compliance period if they get the benefits that they were expecting. And then yeah, and so and secondarily as well is it wasn't, I don't know if Chad talked about it, but a lot of times in the structure that he had, you showed that 99% ownership goes to the investor. And it doesn't mean that you're giving up all the control. So there's ways to move the cash flow to the true economic owner, and then also at the same time, even though you're giving them 99%, you're not giving up control. So you're going to be retained either as a general partner or managing member and have control of the project. So essentially, the third-party investor is a silent partner.
Okay. The next question: can a municipality benefit from the historic tax credit on a building it owns?
There are, jump in on that one.
Yeah, there are ways. Go ahead. Yeah, there are ways that if you enter into an agreement with a for-profit developer, you could do a long-term lease into a for-profit structure. And as long as the lease is structured accordingly, there are ways to rehab city-owned property as is right now. It just needs to be flipped out into the appropriate structure with the appropriate long-term lease.
Do either of you have any examples that you want to share of municipalities that you've seen do anything like that, or a county?
I've done it. Oh, go ahead.
Oh, no, go ahead, Chad.
Yeah, I've done a deal. I've done a number of deals with nonprofits, colleges and universities, for instance. Also, I've done a deal with a county in Kentucky. Did a very large project. Kind of a mixed use. It took an old courthouse and turned it into a fantastic mixed use project. So yeah, we have definitely done it.
Okay, the next question. On small deals, less than 5 million QREs, would they be more appealing if the historic tax credit investor is also construction permanent lender, such as a bank? Do you see a lot of that? Yes or no?
Yeah, this is Paul here. I do not see a whole lot of it. A lot of times if you can, again, it's got to be the right community. And a lot of times if there's a local bank, that's the type of bank that may be willing to do it. Because a lot of times you don't see the construction lender being the tax credit investor. For whatever reason, they want to keep things separate and limit their risk. But in more kind of a Main Street project where you've got local banks that want to be a stakeholder of the community, we certainly have seen that before. And if they want to make a project happen, then they're willing to take on both the credits and the financing.
Okay, the next question. Sometimes some of the nicest architecture is found in places of worship. Are there no historic tax credit funds available for them if they remain a church?
That'll be a tough, and it's a tough one, because if it's going to remain, there's part of, with the tax exempt leasing issues, one of the rules are if you have more than 50% of disqualified leases, it's deemed to be tax exempt use property and is not eligible. And so what comes up is if you have a prior use issue, meaning that if it was a church before the rehab and a church after, even if it is in a for-profit structure, you're going to have more than 50% of disqualified leases at that point in time. So you'd almost have to, you either have to enlarge the building by more than 50%, or have a different end use, or break up the end use. So that does become a tougher project to make work.
Yeah, and I've done similar things with colleges, and it is tricky. You do have to have multiple uses after the building is completed. And the other thing, going back to what Paul mentioned, you lose a tax exemption there, and that can be awfully meaningful to a church.
All right, could maybe each one of you answer, what's the smallest project you've worked on?
Yeah, that's a good question. I've self-monetized deals where, you're talking about even just incurring, $1.5 million to $2 million in QREs. So you're generating maybe 400 grand of credits in that. Again, it's a special situation where you're just assisting the client to help them take it themselves. But yeah, I mean, it's rare that you go that small, but they're out there.
Chad, Alyssa?
Yeah, I'll go ahead and so I have a project right now that we're bringing in an outside investor, and it has 700,000 in QREs. It's a smaller project in Detroit, but like Paul, we've done some that were kind of in the $500,000 of tax credit range. I don't know that I've done any smaller than that.
Yeah, and sometimes I will say this, that what comes up when you're getting to that small of a project, unless you're gung-ho and going to go forward with it, sometimes, and maybe Alyssa could touch upon this, is that there's certain historic features that have to, meet certain standards, and the costs might outweigh the benefit at that point in time. A lot of times it's windows is one of the big ones. So at that small of a project, a lot of times you're forced into doing certain work that otherwise, if it wasn't going to be a historic rehab, you may not get much of a benefit out of it.
Alyssa, do you want to address the smallest projects you've worked on?
Yes. I would agree with what they just said. I have worked on small residential projects that only went for the federal credits, not the state ones, and they were physically like 1,000 square feet, maybe even less than that. QREs around $500,000 or a little under $500,000. But those I've done few of those, and I would agree with what Paul and Chad just said, in that fixing historic fabric often costs a certain amount, and then that just means that pursuing really, really small projects doesn't necessarily make it worth it. But that's just been my experience. I'm sure there are ways to make it work.
Okay, the next questions come in. What is the best deal structure on commercial buildings if the owner wants to be the occupant tenant, such as a hotel or office user? Would it be a master lease type structure to meet the income producing test?
Well, if you're going to use a hotel as an example, I mean, there's no reason you just can't own and operate. That would still be a commercial use of the property. So, I mean, if you're going to use the building as a hotel, it would qualify without having to have some kind of additional master lease. But we've certainly done it, and you got to be somewhat careful with master leases with the safe harbor rules out there. But that as a standalone would qualify. So even if it's self-occupied commercial or office space, it would still qualify.
Okay, we're at the end of our questions. Does anybody have any other questions to type in? Any other suggestions for future webinars? on historic tax credits? Well, I think not. So thank you so much to Chad, Paul, and Alyssa for sharing. Oh, here, wait. One more question that we can do. Are developer fees or general contractor fees qualified?
Yes, there are limitations on developer fees, but generally speaking, yes, they qualify. Again, you get into these safe harbor rules where you have to have what's deemed to be a reasonable fee when they're related parties. So if you have a related party contractor, you've got to be cognizant of it. And if it's a related party developer fee, then same thing. But generally speaking, yes, those would qualify as QREs.
And there was a follow-up. Are they capped by the IRS? I guess that goes to what are they, or how are they judged as reasonable?
Yeah. So there are, typically when you have a third-party syndication, what's going to be required by investor counsel is a reasonableness opinion so that they can issue a tax opinion. And it's really an analysis to be deemed if the fees are deemed to be market, basically. So as long as they're within market range, they should qualify.
Okay, I've got
Joyce,
no
that
other.
really goes to
Yeah.
that goes to my slide about the safe harbor. So I'd direct the person to maybe look at that. It's really just a function of not reducing the investor's interest by virtue of above market arrangements and fees.
Okay. That's, again, I haven't had another question come in. Thank you so much again to our presenters. Thank you for all our attendees. You will be receiving this recording from the GoToWebinar software, and please let us know how we can help you. Thank you, guys.
Okay, appreciate it.
Thank you.
Thank you.